The big banks are freaking out. And in this video, I'm going to expose their big secret. More on that in a minute. But first, we have to talk about why are the big banks freaking out? Well, we've seen some pretty big numbers come in for the banks recently. JP Morgan increasing their odds of a recession dramatically, all the way up to 35 freaking percent, 45% for next year. Goldman Sachs went all the way up to 25% odds of a recession, but then they decreased them. They said, our bad. Sorry, it's not 25%. It's going to be 20% now. Just in case you're wondering, Goldman Sachs has a track record of being hilariously wrong. You can see this chart here that shows basically back in early 2022, the recession odds were 50%, more than 50%. Recession never came. Technically, the USA did have a recession, but we don't count it like that anymore. It's 2 quarters of negative GDP growth. No longer fully count as a recession, right? So they've been wrong, and then wrong again. It's crazy. Bank of America, on the other side, taking the other side of the bet, saying they no longer forecast a US recession in 2024. So the big banks are oscillating back and forth between holy crap, a recession's coming to, no recession, we'll be fine. A lot of stuff's happened in markets the last few weeks that have made the big banks freak out a little bit and dramatically increase their chances of a recession. But data's saying something different. And that's an interesting part of the story that I want to dive into with you. Now, real quick, before we do dive into that, just a quick note. If you're not signed up to the Wealth Mastery newsletter yet, check it out. It is our weekly crypto investor report. Basically, you're going to get all the latest on altcoins, meme coins, charts, and much, much more. We help you stay ahead of the curve with all of the latest insights and opportunities in the market. It's free. 140,000 people a week are reading it and loving it. I'm sure you will too. Check it out. Link down below in the description. Now, we have to talk about some of the data because, well, the big banks had a big increase in their chances of a recession coming. And, you got to keep it all in perspective. To even the most bearish take right now by JP Morgan is like, best I can do is a 1 in 3 odds of a recession in the next year. Not too crazy right now. The big banks lie. The big banks can be wrong all the time. More on that in a minute. But a lot of things have been weighing heavily on the markets recently. And I know the big one that everybody keeps pointing back to, and we did a video breaking down the yield curve recently, but it's the yield curve, man. Everything else, just ignore everything else. Literally nothing else matters. Just the yield curve, man. That's it. That's telling us a recession could come in the not so distant future. Now, it has been inverted for its longest period since 1929, which is not a great comparison, right? Which is leading people to say when it uninverts, it is going to be the worst recession since 1929, which is not good. That's bad news bears, guys. It is still not uninverted, by the way. We came very close to uninverting last week. Didn't happen. Still uninverted. How much longer can it be inverted for? Nobody knows. Nobody knows. But it could be a while longer. And as long as it remains inverted, the big scare of the recession keeps getting kicked down the road. When it uninverts, then usually you'll have a recession declared in the USA 2 to 6 months later. The question, has the central banking, money printing, monetary madness finally broken the yield curve? Is this going to be the time that the yield curve is a false signal and the Fed actually pulls off a soft landing and everything kind of ends up being okay-ish? It's an interesting bet to take because the yield curve has been so spot on for such a long time. Anyway, we shall see. But it's not uninverted yet. And when it does uninvert, then you can think, well, okay, maybe 2 to 6 months, we have a recession finally come in and then markets are going to take a beating and so on and so forth. But until then, everything's kind of remaining pretty stubborn for U.S. markets. And this has been part of the problem for Goldman Sachs and JP Morgan and everybody constantly calling for a recession. The U.S. economy has just remained stubbornly okay, which is crazy. The labor markets have remained pretty stubborn. We had some pretty good job data come in recently showing that, actually maybe the labor markets are doing okay. We had the PPI data coming in. So this is the producer price index, the price that producers actually pay, make stuff with. That's come in better than expected. CPI, as the core consumer inflation, that came in better than expected. Once again, inflation's down across the board. The GDP for the USA It's very interesting. It's pretty hard to have a recession when we have GDP numbers like this. Q2, 2.8% growth versus 2.1% forecast. That means the USA absolutely blew away the analysts who had said, oh, we're only going to get 2.1%, which is still bullish, by the way. Just, again, it's not negative growth, is it? It's not 0.1% where it's like, oh my gosh, we're hanging on by the thread here. No, 2.1% was still going to be just fine. But 2.8% came in way above expectations. The US economy just won't be kept down despite all the challenges, despite all the bank freakouts. It keeps grinding forward, and forward-looking projections showing about a 2.4% potential growth for Q3. Now, there are some things that also triggered some pretty strong reactions from the market. We had this thing called the SAM roll. We did a whole video on that. Go watch that, breaking down why that may have actually been a false signal. So basically, you had this hurricane, was a Hurricane Beryl. You had this hurricane happen, and that screwed up the reporting of jobs data, which was likely much better than was reported. And because of that, this SAM rule triggered. And even the lady who created it came out and said, probably a false signal this time due to the way that data was being reported. So it's pretty crazy, isn't it? We have all these big banks freaking out all the time and freaking people out by constantly calling for a recession. And I know broken clocks right twice a day, right? But still, it's been pretty crazy to watch from the sidelines to see all this fear and panic in the markets and driven by these forecasts from the big banks. But here's the big secret, what the banks probably don't want you to know. The banks, they don't know shit, man. In fact, not just the banks, nobody. Nobody knows anything because nobody has a crystal ball. Nobody can predict the future. We have our models, we have our thoughts and our processes and our frameworks for looking at things, but then all that stuff gets thrown out the window because things don't always operate the way that you think they might. Sometimes economic data, for example, can just remain surprisingly stubborn in the face of all kinds of crazy economic challenges. The US economy just keeps trucking forward. It's crazy. Remember, Goldman's been calling for a recession within the next year for more than 2 years now, giving it very high odds at sometimes and being spectacularly wrong. Okay, US economy just not stopping. The guys whose literal jobs it is to tell you this kind of stuff, the big bankers at JP Morgan and Goldman Sachs and Bank of America and everybody, nobody knows what's going on, man. This is literally these people's full-time jobs, and they have no idea. There's that old joke that an economist will tell you that a recession is going to happen 8 out of 5 times or something like that, or they'll call it 8 times before the 5 actual recessions happen, something like that, paraphrasing. But you guys get the point. Look, at some point, the USA is going to hit a recession. Is it going to be the big doozy recession, the one that ends all recessions, the new Great Depression? I have no idea. They don't either. Banks don't know. I don't know. You don't know. We'll see, right? Recessions are a normal part of the cycle of markets. They are. They come and go. The only question is it going to be the big doozy, or is it just going to be a kind of regularish recession where, a few years of boring economic whatever, and then things recover and everybody's off to the races again with the markets? The one thing that you can control, you can't control any of that stuff. You can't control what's going on with the big banks, can't control what's going on with the US economy, you can't control the yield curve uninverting, you can't control the jobs data, none of that shit. It all affects your investments, but you can't control any of that. What you can control is your portfolio, which means that you have to think about how to make yourself ready for these events. Now, I think the best days of the markets are still ahead of us for this cycle. We still have a lot of time to make money, but always be prepared for in case you're wrong. If you have a long time frame on your investments, you're going to be fine. If you're managing your risk, you're going to be fine, right? Don't go all in on dog coins, guys. All right. You want to have cash on hand to ride out volatility whenever it happens, because volatility comes to markets. Keep your leverage down. Lesson I had to eat some humble pie on recently, right? Got too much leverage in my portfolio, had to pay the price for it. Shit happens. The key thing is to make sure that no matter what happens in markets, you're resilient, that you're able to take care of yourself and your family no matter when things go wrong, because things will go wrong. That's what happens in markets. The good times never last forever, nor do the bad times ever last forever. And right now, it's looking like, despite all the banks freaking out and stuff like this and raising their recession forecasts and stuff like this, the US economy for the moment keeps trucking forward. How long that lasts, who knows? I don't. They don't either. Again, focus on the things that you can control. Take care of yourself, take care of your family. Make sure you have cash to ride out volatility while also still maintaining exposure to markets so that you can capture upside. It's a balancing act constantly, but it's our favorite game, isn't it? We love it. Wouldn't trade it for anything else. But make sure you're playing the game safe, guys. Thanks for watching.